So, hello and good afternoon. I welcome you to today's Trading Spotlight webinar here together with Admirals. It's Friday. It's the 17th of March, 2023. And today we want to have a look at the Fed, the upcoming Fed meeting next week on Wednesday, and especially given the current developments in the regional banking sector in the US. We have to have a look at what's going on there. We have to have a look at what the ECB delivered yesterday, because I think we can be sure that central banks around the globe will have talks with each other behind closed doors, and especially in the current environment. So, yesterday was kind of surprising, let's say, to get to see a 50 basis point rate hike. And right now, just have a look at the charts, have a look at what's going on in gold, have a look at what's going on in the DAX. Initially, we drove higher. Yesterday, I was kind of surprised, to be honest. I thought we would sell off yesterday already. But we turned around, and especially tech and risk appetite was there, especially semiconductors. You probably have seen that nearly went vertical. So NVIDIA, for example, SMH still about to break out to higher highs. So there's certain risk appetite in the market for sure, especially in the big tech companies, which will definitely profit over the long run from lower rates, respectively QE, which is back, by the way. I will show you a chart which will show you exactly that. But still, we've now seen that these gains were sold off again. And that's mainly due to the fact that we haven't yet seen the worst, in fact, because now more and more market participants seem to realize that a more restrictive course and the rhetoric which was used from the ECB and ECB President Christine Lagarde yesterday, well, to be honest, was kind of ridiculous, to be honest. To what we heard there was like, as she said, well, it's price stability, and this is not directly correlated, probably we can say that, price stability, so the fighting inflation, with the financial stability, which seems kind of weird, to be honest, because saying, well, we hike rates to fight inflation and still provide liquidity to banks, somehow try to bail them out and make sure that the banking sector is not affected by higher rates, seems kind of counterintuitive. And right now, I'm not really sure what to make out of this. I think that won't play out. And market participants seem to realize that now. So at least that is what I make out of the current environment. Difficult to trade equities in this environment, difficult to trade the DAX, especially if you see what's going on there. But the breakout in gold higher, that's something we could have traded, in fact, and that's also something I want to show you in the upcoming minutes, and what to make out of all this, and what to expect from the Fed next week, how to game plan then for the event, and then taking it from there. So that's it around the introduction. So let's have a look now at how to prepare for the Fed, where we stand, and so on and so forth. If you have any questions, by the way, then feel free to ask them right now, live here in the event, in the chat function. If you're watching the recording now on YouTube, please make sure that you leave a thumb up here if you like what you will see now. Subscribe to the YouTube channel, and also if you have questions, then please feel free to enter your comments in the comment section below. And so, very important, we have to make sure that we are aware of the risks involved when trading the markets. And it could be that we're formulating trading plans or setups here. Please understand that everything I present to you is for informational purposes and educational purposes only. So it's not a financial advice or something like that. It's only to give you an idea how to prepare for such an event, how to game plan for such an event, which markets could be of interest, which are of our interest right now in the current environment, which could be very interesting to see. Probably we formulate a setup, an idea on how to trade this then, but please make sure that you understand that, first of all, leverage products, derivatives, in this case, contracts for difference, you see, if these, they are leverage products and they involve high risks, so are not suitable for all investors. Make sure that you understand all risks involved before you trade. Make sure that you consult, let's say, a financial advisor, for example, an independent financial advisor, if this product suits your trading, respectively your personality, your risk profile, and then take it from there. Download the demo, check it out, try it out, and then take it from there. But please don't take anything here as financial advice, but this is for educational purposes only. Then I don't think I need to introduce admirals, because I think you might have followed us already in the past and then followed all the introductions from Theo especially. If not, feel free to check out the website, admiralmarkets.com, for further details on the broker. So highly competitive offering. I can only recommend it. Check out the website. And when it comes to FX trading, index trading, commodities trading, equities trading, whatever, I think you will definitely find something which is of interest for you when it comes to financial products. And so fully regulated broker, that's also something around the globe. You can find offices from Admirals. And now what we want to do is, oh, by the way, I'm sorry. No, I'm not really sorry, to be honest, because this is perfect. I haven't changed this. I haven't changed this graphic here. In fact, we will go through this in a few seconds. So I'd like to head over. I'd like to head over here to a chart, and let me just check something out. This is weird. So usually you should see a risk disclaimer here at the bottom, but unfortunately this is not visible. Let me just see what happens if I do this. Oh, this is interesting. So now you can see the risk disclaimer in German. Let me just check out the English one. Probably that works too. Huh, that's interesting. Let me just play around a little here. Let me just test this, and then, there we go. So now we have the English one. However, so what do we see here? What do we have here? This is the Fed balance sheet. And this is interesting, no? Well, have you seen what's currently happening here? So have you wondered what this is? Let me just, by the way, enter a chart I just came across before I started the event. And then we want to have a look at this chart here too. But before we come to this, then first of all, let's have a look at this. And what we know is that we're currently in an environment where the Fed, the US central bank, hiked interest rates aggressively to counter inflation that took place over the course of the last year. You can see here that from a balance sheet of over 9 trillion USD, we reduced this by a mere, in fact. So it's nothing. We didn't do anything, to be honest. We reduced it here by something like 600 billion over the course of the last 12 months. So this is 1 year, the 1 year period, just to put this in perspective, by the way. So inflation came down over this course. So, well, we could somehow say, okay, we loosened, or we were more restrictive in our monetary policy terms, and that dampened inflation, respectively the outlook. But have a look here at the countries. So this is trading economics, by the way. I highly recommend checking out this website because you have a ton of fundamental data you can use to build a big macro theme. Oh, it's labor. I'm sorry. I wanted to have a look here at prices. I'm sorry, still not. It's money. It's money and the central bank balance sheet. So this is the course, the last 6 months, 1 year. Let me check this out. Yeah, something like that. Let's have a look here at the last 25 years. So this is the central bank balance sheet of the US central bank. So the Fed, you can see here, we saw a first pop higher. That was around the great financial crisis with Lehman Brothers going down. You see that there was a large increase. They more than doubled their balance sheet back then. We stabilized but continue to pump liquidity into the markets. Then we went significantly higher. That was when I think was QE3, if I'm not mistaken, where we're introduced. That was in fact indefinite QE, and then we topped out. That was around when the 2014, I think that was when we tapered, and then we topped out, and then we started to hike rates. And then you can see here that there was a reduction of the balance sheet. This took place over the course of 2018. Some of you probably recall what happened back then. the way, it's still not there. This is interesting. You can see it here. Once I this is interesting. That shouldn't happen, in fact. It should usually be at the bottom of the screen all the time, but it isn't for whatever reason. Oh gosh, one sec. So there we have it once again. Okay. However, so let's have a look back here at the let's take the NASDAQ. This is interesting. Did you see that? It just disappeared once I clicked on the chart. Why is it not fixed? So I'm not really sure if that makes sense now, but let me just check out here. This is a very interesting. This is very interesting. Let me just check this out once again. Okay. Okay. So there we have it. Okay. What happens if I click here once again? It's gone. Okay, whatever. I'm sorry. So usually you should see a risk disclaimer here all the time. Unfortunately, I just click, you saw it, and then it disappears. That didn't happen in the morning, by the way, when I had it open last time. So whatever. Oh, okay. However, so weekly chart. Let's go back here to 2018. You can see there was highest volatility back then in the fourth quarter. It was the fourth quarter of 2018 here in this environment. And so having this high volatility, elevated volatility back then was certainly or had to be connected here to the developments we've seen here with the reduction of the balance sheet back then. So it was quantitative tightening. So it's like you have quantitative easing, like you increase the balance sheet. Then you have tapering, you reduce the pace with which you expand the balance sheet. And then you start to tighten, which means you reduce the balance sheet once again. So, and that being said, we can see here that obviously, by the way, let me just check one thing. Let me just check out one thing. I'm just curious about this, to be honest. If I click this one and click here, so you can see, this is interesting, no? So now you have it. This is the German disclaimer. So it says the same. It is the same as is the English one, but the English one disappears for whatever reason. That's interesting. So I hope this is fine too for the regulators to see the German one. So I'm willing to show it. Unfortunately, it disappears in English, but you have it in German. So it reads the same as the risk disclaimer at the beginning. So I already talked you through this here, and so seeing here this reduction now of the balance sheet back then, you see there was this reduction, and then there was this short pop higher. So we started to increase the balance sheet back then again. Some of you probably recall what happened there. You don't have a it's not, you can't read it here on the x-axis, but it's at the end of 2019. It was in around September, and there was lots of tensions and spikes in the repo market. It's very, very important market for liquidity, to get liquidity as a bank, especially. And there was the need to increase the balance sheet back then. If you ask Jay Powell back then, he was talking about, well, this is a technical thing and it's not QE, and well, at the end of the day, it's an increase of the balance sheet. It was significant, the increase of the balance sheet. And then we saw the explosion of the balance sheet following here, the liquidity injection following the COVID pandemic. And the same thing is happening right here, right now. Because now you will see in the media, some people will talk to you about this obvious increase in the balance sheet of 300 billion, just by the way. So looking at this, so we reduce within the last 12 months, we reduced the balance sheet by 600, 700 billion. And then we increase it within 1 week, 50% by what we just reduced the balance sheet. Okay. And it comes together with banking's failing, let's put it that way. So in terms of Silicon Valley Bank, what did they do? Let's try to make it as easy as possible to understand what happened there. So Silicon Valley Bank, but also other banks like First Republic. So it's a small regional bank. In case of Silicon Valley Bank, they loaned out liquidity / loans, gave out loans to startup companies. And during this liquidity here, this liquidity increase from central banks around COVID, there was so much liquidity in the system that they were overrun with all this liquidity. And so people headed to Silicon Valley Bank and deposited their money there, respectively gave the money to the bank. And now they had all this money in the bank accounts, let's say, but they just don't keep it there, but they hand it out, they loan it out. And the thing is now they loan it out over a quite long period of time. So which means like you, for example, loaning it for 10 years or even longer than that. And this let's say there's a mismatch. So they were not loaning it out only to startups, but also with this liquidity, they were buying bonds, US bonds, treasuries, having it available and being capable of liquidating all the time. Because now, if you go to a bank and want to have liquidity, you're going to the ATM, let's say, and you want to get your money out. Well, what would you usually do in this context? You say, hey, bank, give me my money. And then the bank has the liquidity there. The more people come, the more liquidity is needed. And thus, they have to liquidate some of their holdings in treasuries. The thing is now that the Fed aggressively hiked rates. And as you may know, if you hike rates, the price of a bond drops, and the other way around. So if you bought aggressively bonds over the course of the last, let's say, 18 months, probably 24 months, as they did, well, now you have people lining up in front of the ATMs due to whatever reason. I mean, it could be a simple reason, like, well, inflation picked up and now you have to pay significantly more for your bread, butter, milk, whatever. Or there might be reasons to be skeptical because the last earnings release from the bank wasn't just that promising anymore. And you were starting to be kind of skeptical if your money is still safe with this bank, because they were losing money. This is what they gave out, let's say, as an earnings release in this context, for example. So what you say is, well, I want my money out of the account. So now the thing is, if you're holding bonds, especially US treasuries, you don't need to say we are losing money, but it's a floating loss. And you don't need to put it as a real loss, a realized loss in your balance sheet, respectively, in your earnings release, as long as you didn't realize it. Because you want to hold them, the bond till maturity. The problem is now, if there is liquidity needed short term and you need to realize the losses start to build due to this hiking cycle in which we find ourselves in with the Fed. So you're realizing losses, and thus the overall earnings release which you're giving out looks not very promising. And this is like a vicious circle, because now people start to get more and more worried about your solvency and saying, hey, I want my money out. But the bank doesn't have the money there because they lend it out in the longer on a longer time frame. So they have to liquidate their bond positions at a loss, which is like a reinforcing cycle. So that being said, now it's mainly driven, as you may have realized, by the restrictive monetary policy path from the Fed. So the Fed is responsible for that because they hiked rates. First of all, well, certainly they will say, well, we have to fight inflation, and we're not responsible for you depositing your liquidity in US treasuries, let's say. They could certainly say that. The only problem is that, first of all, the communication was in a quite direct way, that they will keep rates at a low level for an extended period of time. first of all. And in addition to that, it's also clear that if you don't keep things in relation to each other, let's say, or if you're risking to lose control, because if one bank fails, there's the risk of a bank run. That was something which developed now over the course of the last week, especially over the last weekend, where then the Fed stepped in and said, well, guys, we deliver liquidity, but it's not a bailout. It's not a bailout, but it's a liquidity. It's like we helping out banks to make sure that. And then they started to talk to other banks. JP Morgan, I think, was one. And there's also other big banks, Morgan Stanley. I'm not really sure. I don't have the list available. But they were all depositing billions into, let's say, First Republic, for example, First Republic Bank as another, to avoid that there's a run, but instead that this gives trust to the people to trust the banks and to don't take the money out of the banks, in fact. So that's right now what's happening. And then this spilled over. You probably have heard the news around Credit Suisse in this case. So Credit Suisse is under fire for some time, let's say. So it's not that this came out of nothing. And it's a systemic risk because Credit Suisse has business relationships around the globe. It's a very big Swiss bank. And the thing around this is that now Credit Suisse is also feeling tensions due to the tensions building in the financial world due to resulting out of the regional US banks, which is then, by the way, let me just head over here to the DAX, which is then, let's go here to a daily chart, which resulted in a sharp drop. This is the DAX now on a 30-minute chart here. That was a sharp drop. It was, well, we saw some pressure building over the course of last week, but then stabilized, came into the week, saw some buying, and then we sharply sold off again. That was on Wednesday. And this sharp sell-off here on the downside, and yesterday the flush lower than due to the ECB, something I will come to. So that is out of the fact that now it seems as if this is spilling over to European banks too, which makes sense because the global financial system is interconnected with these outlets for sure. So you see now that there's fears around Credit Suisse rising. Now there was like a pressure forming from a big government, major government. That was a rumor. I think probably most likely was Germany. Probably there was also other banks putting pressure on the Swiss National Bank, for example, respectively their banking authority in this context, to make sure to provide liquidity in the case of emergency to Credit Suisse to avoid a collapse of the bank. However you put this, yesterday with the ECB, and knowing that the main driver out of this current turmoil comes from a central bank, or the behavior of the central banks and how restrictive they were over the course, and it's not just the Fed, but it's also the ECB over the course of the last months to fight inflation. Well, everyone was sure that the ECB, well, everyone was sure, that's probably a wrong way to put it, but I was at least sure, and there was plenty of other traders too who thought the same way, that the ECB won't hike rates by 50 basis points as expected. Probably 25, probably not even 25. And then that should give some kind of, how can we say that? It's like taking the pressure and reducing the tensions in the overall system. It's probably a fair way to put it. That's probably a good way to put it. Well, and this, by the way, then the ECB not hiking by 50 basis points means that we can also expect something similar to happen then from the Fed next week when it comes to their rate decision, so that they don't hike rates. Well, it turned out that was wrong because as you can see here, you can see European central banks hike rates despite market mayhem, pledges support if needed, 50 basis points. And in addition to that, there was also Ms. Lagarde then saying, let me just see if I opened this already. I think here that we have, no, it's not. I'm sorry. Let me just go back here, scroll down a little. Here, that was the tweet from Holger Chapitz. This is a German journalist. But still highly recommended following. He's only tweeting in English, so it's definitely worth a follow here. So Lagarde said there was no trade-off between price stability, price and financial stability. So Lagarde referenced the separation principle that lender of last resort function address financial stability concerns, while rate policy addresses price stability needs. Not sure what to make out of this, to be honest. So because in my world, these two are strongly connected with each other. I mean, well, we know that there's kind of well, to some extent, it's arrogance. What we can hear from many politicians, and it's also true for central banks. It just doesn't make sense. It just doesn't make sense. It's like you hike rates to fight inflation, and you really think that this won't affect the financial stability. Just like, I don't really know what to make out of this. It's really like, it just doesn't make sense. The same is, but this is also something to make, I'm sure that you understand. So I'm located in Germany, and here were people who were going to court, bringing to court the QE decision from the ECB and saying, well, guys, this is like you're directly financing member states of the Eurozone, because you're buying their bonds. If you buy a bond, you hand out money liquidity to them in a direct way, and there's direct financing these member states, and this is forbidden by law. We have a paragraph stating this in the contracts of the European Union. And then they were saying that was what they ruled, and you just looked at this and just think, are you serious? They said, well, this is not a primary market where you buy the bonds. It's not direct financing, but it's like you buy the bonds via the secondary market. But it should be clear that the prices of the secondary market, if you buy them there and you affect them, that this directly affects the prices in the primary market. Because if you know that there's a buyer who's buying whatever it takes, so this is the words used by Mario Draghi back then. So there's the ECB buying at whatever price is offered to save the euro. Well, you can be sure that you can certainly also buy at whatever price in the primary market, because you know that there will be a buyer. So a lender of last resort, this is what this is referring to in the secondary market. So it should be clear. But this is how they argued in this context. And everyone laughed and said, okay, well, then probably times have changed and whatever. So don't overcomplicate things here. The thing is, this is like, well, probably she doesn't understand that. Probably, well, she knows exactly what she's talking about and is somehow trying to calm the markets down. Whatever it is, initially, markets bought it. It's like they said, well, this is great, because it seems as if they have everything under control, and they will step in if things get out of control. And so we saw an initial sharp run higher after an initial flush lower, and then took off from there. And in the morning too, we kept on buying. We kept on being optimistic about this. Something broke. It just broke because market participants realized, hey, something's wrong with that. It's like, it just doesn't make sense. And you can see that it's clear. DAX is now under pressure, something like 2% or so. Yeah, 2%. And is about to head for these lows here, while US equities are still stable. Right. So look at the Qs, or respectively NASDAQ. Yes, sure. We come in here with selling now due to the developments in the European markets, but still we are stable. Attack in general, we don't want to put this now also here, but something to keep in mind when we finally formulate a thesis for the Fed next week. The same is true for the S&P, even though the S&P is a little more under pressure. The reason for that, this is now a 50-minute chart here. The reason for the S&P being under pressure is because it's not a solely tech sector like in the Nasdaq, which is currently outperforming due to expecting lower rates in the future. But it's also banks, for example, you can find in here. And if the banking sector is under pressure, well, this is certainly also weighing on the S&P. The S&P, on the other hand, outperformed over the course of last year because there's also like oil companies within it, while the Nasdaq really sold off sharply due to only being focused on tech. So the thing now is market participants obviously realize that there's something wrong with this. And the reason why the DAX is relatively weak compared to US equities now, I think, is because coming back here, well, we just saw a rate hike of 50 basis points. And obviously, the ECB, respectively, the president of the ECB, Ms. Lagarde, didn't build anything or didn't really show that the ECB is willing to step in. But instead, they said, well, guys, you know what? We have to hike because else you might spot some weakness at our end. We want to fight inflation. And if we don't hike now, you could come to the conclusion that there's something wrong in the system. And we don't want to make you thinking that, which seems kind of ridiculous to some extent, but well, at the end, this is exactly what we got to see now. And now, after the market lived a little with that, the market realizes, hey, that's really bad, right? So this is really, really bad what they're delivering there. And in addition to that, they can't see those two independent from each other. So price stability and financial stability, that's just not working. And again, looking now at the Fed is let's say doing the right thing. Oh, I'm sorry. This was here doing the right thing, even though there's also some people now arguing, well, this is not QE, it is QE, full stop. That's what it is. And it will result in an even sharper run in QE, which is the reason why tech is outperforming here. So looking at next week, this will be of interest to see if a journalist asks Jay Powell here, Mr. Powell, what about the QE, which you're currently running? He will say, no, this is just technical, whatever. And he will probably argue that with this here. So what you're currently witnessing is that there's lots of tensions. And what we have here is the so-called discount window borrowing. So you can see it here. So the tweet says it all. So it's a record high, 152.85 billion USD borrowed from the Fed's discount window this week. That was the all-time high. The prior all-time high here was 111 billion in 2008. So we are currently seeing banks borrowing at the highest rates in US dollar terms ever since the great financial crisis in 2008. Well, you don't do that if everything is under control. By the way, you can also see that here. There was another spike. You remember that one? So that was even close. That wasn't even close to the highs here. That was around COVID and the pandemic and lockdowns and everything. So this is a sign of tension in the system, and the Fed does everything in their control to make sure that things don't spiral out of control. And this is exactly what we can see here. And this is exactly what you can see here now with the balance sheet exploding on the upside once again. And if I'm not mistaken, I think it was JP Morgan who said in a research note earlier, they said that they expect the balance sheet to expand by another 2 trillion within the next 2 years. They said, I'm not sure, probably 2 years. Because of the current crisis we have in the banking sector. So having that in mind and looking at this here, well, it brings us to what to expect from the Fed next week. It's still surprising to see that we have an expectation, given these current developments, in fact, in the Fed watch tool here, of the Fed right now, or next week, hiking rates by 25 basis points. So this is where we stand. This is where we expect the market to be, or the Fed to stand, in terms of their target rate next week on Wednesday. And by the way, when I talk about lower rates in the future, you can see well, they still expect, market participants expect the Fed to hike to 475 to 500. Let's have a look here at the December meeting and have a look here at where we stand at the end of the year. So at the end of the year, we are 100 basis points lower. And by the way, after the semi-annual hearing from Powell last week on Tuesday, that was 2 days before everything started to spin out of control with Silicon Valley Bank, by the way. So like, let's put it that way. Well, this is what he said last week on Tuesday in front of the US Congress. Powell said or warned that the Fed is prepared to return to bigger interest rates. And that resulted in a spike higher in yields. By the way, I don't have 2-year US Treasury yields now here available, but you can see that there was a spike up to 5%, while the expectation of the Fed hiking further over the course of the next month, it resulted in December, market participants expected, you can see that here, by the way, you can see that the market, unfortunately not, it's already out because of Silicon Valley last week, but we had expectations of 475, sometimes even 600 basis points at the end of the year. We cut this by 200 basis points from these highs last week within 1 week. Within 1 week, due to the turmoil we have currently in the banking sector. And that being said, it means nothing more than that the Fed will deliver a quite dovish statement. That's what's to expect. Right now, the market is expecting 25 basis points, despite the current developments. Probably they will go a similar course as the ECB went yesterday with 50 basis points hiking while saying we deliver liquidity. The Fed delivers already liquidity. So this is probably calming down market participants in the US a little. But if things now turn worse, in case for the DAX, which is currently trading down to the lows from yesterday and about to break lower here, and probably we continue on the downside, that's something the Fed will notice and probably will say, yeah, guys, probably we shouldn't hike rates because this could really result in massive turmoil. And meaning that we hike rates now by 25 basis points. And then next week in an emergency meeting, we have to cut rates because markets are completely losing it. And so that's definitely something to look at. I would say my personal view is, or my expectation is, that given what I just presented to you, the Fed won't hike 25 basis points, but instead, not just that they don't hike it, but in addition to that, also that we should expect. Let me just see if I find this here. Yeah, that's good. So in addition to that, we have now a look at the dot plot. 1 second. When was it? It was the 14th, I think. Is that right? Ha, perfect. So you can see that here. It has the date. It's the 14th of December. That was 3 months ago. 3 months ago, it's the summary of economic projections. That's also something we get to see next week. And if we scroll down a little here, so that's a lot of technical stuff, this is what is of interest for us, because these are the dot plots. And you can see that the last meeting in 2023, the Fed officials who are represented, each of them is represented here, a voting member with a dot. You can see that 500 to 525 basis points was what market or the FOMC saw at the end of 2023. If these dots, if let's say they deliver 25 basis points now, but the dots can be found somewhere around 4% here now, 3 months later, this is a direct sign from the Fed to the market. Guys, we hear you, we see you, we have trouble in the financial system. Well, you can see it yourself. Just have a look at our balance sheet. Just have a look here at these charts. I'm showing the discount window borrowing and how much liquidity is taken from this window here being open right now from banks, obviously, at a higher rate than it was ever before and around the great financial crisis with Lehman Brothers. So, well, tensions are there, obviously, and we hear you, and thus we guarantee you, or we see lower rates from here. If this is what is delivered, in addition to the current QE, which is visible here with the balance sheet expanding again, In addition to that, this is a clear bullish sign for equities, especially in my opinion. This is bullish for tech, for the tech sector. So I prefer tech over the broad market, let's say. So I really think that we have a good chance here to break to new yearly highs. Yesterday already in the Nasdaq, what we've seen here is, it's, by the way, this is a potential flag which was just broken yesterday, and the projected target of this flag, if you use this here, well, then we're somewhere around the highs here of August 2022. So this is a potential projected target. But taking this away here, there was also yesterday a strong breakout above a quite important level, which I think is important for us today, because we want to see the Nasdaq closing above into next week, by the way. So also into or till Wednesday. I want to see the Nasdaq closing here roundabout 12,300 points. You want to see market participants, or respectively bulls here, holding this breakout level from yesterday. If we can achieve that, that's in my opinion a potential reason to be positive into the news event itself, and we have a clear level to risk against, because we know if we get the Fed the way I just described it, rate hike 25 basis points if at all, but a clear lowering of the dot plot, well, then we expect markets to take off. If market doesn't take off, if the Nasdaq doesn't take off but breaks back below 12,300, we know, well, obviously we are not bullish right now. Then we have to reshuffle the deck, let's say, and see where we stand and what to make out of this information. If we hold above that level, this is, in my opinion, a clear bullish sign, even though I'd probably dig even a little deeper into the tech space and head over to, oh, I'm sorry, by the way. I thought I had it open. So this is semis. This is a semiconductor ETF. It's SMH. We have a potential breakout level here. You've probably seen that yesterday also, and NVIDIA, for example. So NVIDIA really took off. So where do we stand right now? 262, I think, came in a little. Still 260. So this is a delay because it's a demo account. It's a delay of 50 minutes, and we are still trading at the highs. So yesterday there was a strong run higher here into the close. We saw another push. We gapped higher. We have the turmoil in European markets right now, and we are still holding at these levels at 260. Coming in a little, yes, but still we are holding. Let me just check out my chart here. We just dropped VWAP. So it's like we slightly dropped below that. So this is not ultra positive, because yesterday we clearly hold VWAP all day. But still, this is still extraordinarily strong. Short term, very overbought, no question about that. But coming back here to the SMH, so the semiconductor sector, we are holding extraordinarily well in the current environment, given all the turmoil, and given that there's lots of hawkishness and potentially being priced out, gives us further room on the upside. So with a break above, this is the region around 256 around, I think SMH is a very interesting breakout candidate, which would potentially minimum bring us up to it's 282, right? Yeah, it's 282. That's the region around the March 2022 highs, respectively, into the region here of the bounce high in February. That was shortly before there was the invasion of Ukraine from Russia. It's a region around 288, 290 around. So there's plenty of room on the upside. It's not just the swing opportunity, but also if you get to see a breakout and hold above that level, could also be an interesting trading candidate from an intraday perspective. So SMH is definitely worth a deeper look, especially if the Fed delivers dovish remarks next week on Wednesday. And the play of today, and I'm loving that, and you can see it's still my chart here, by the way. So that's what I presented to the German audience in the morning. I told them we saw an initial drive higher in the in gold over the course of the developments around banks in the US. We already took off last Friday, in fact, so that wasn't necessarily driven only by the non-farm payrolls, but it was also driven by all the developments in the banking sector and market participants anticipating there will be a liquidity inflow or push from the Fed because it's needed. And as you can see, well, these guys were right. And then we saw another push higher. That was around Credit Suisse. We pulled in, we held the breakout level here. That was this region around 1,910. Pushed to these highs again, came in, held higher, and that's forming then an ascending triangle. Now that was what we saw in the morning. Very tight consolidation here, very tight consolidation, slightly below potential breakout level to new weekly highs. And I told you the German audience, the German Admirals audience here, guys, this is a potential breakout level. If we get out of this, it's likely that we are pushing at least up to this red line. Where does this red line come from? Well, that was the market, the yearly highs here, and probably even push above that, as we're currently seeing here. And that makes sense from a sentiment perspective, from a fundamental perspective, given the liquidity being provided from the Fed, certainly makes sense because we expect yields to come in. Lower yields mean for a safe haven like gold, a push higher. But in addition to that, it's also, we have a weekend right ahead of us, and market participants just don't know what will happen, especially when it comes to Credit Suisse right now. Well, and now just imagine you're managing a portfolio and you want to hedge, and you see that things completely spiral out of control given the current volatility in the market, and insurance buying put options in this case, for example, is quite expensive, even though you don't really know, do I really want to fully hedge the exposure or probably just hedge part of this? Where do we stand on Monday? Will there be a turmoil? And what you naturally see then is market participants heading to a hedge here, in this case, over to gold and buying paper gold in this case, and at least hedging some of their exposure into the weekly close. And probably we won't see a follow through on the upside into the next week. But right now, I think this is also a driver higher, which is currently resulting in this strong run higher. We should probably expect rather sooner than later a consolidation at an elevated level. If we can hold above this red line, 950 around, I think this is a clear bullish sign. And if we come out very dovish next week with the Fed, I think it's definitely very, very likely that we'll head up to 2000, and even, or probably we will slice through that straight away and go to new all-time highs here in gold and push up to 2100 and probably even higher than that. So gold is right now running strong, very strong breakout. If you haven't traded this breakout right now, don't chase this run. There will be a consolidation rather sooner than later. Market will see, will we get to see similar pull-in as we've seen on Wednesday, or will we hold at an elevated level? I tend to the latter, given that's Friday and people want to hedge some of the exposure over the course of the weekend and don't knowing what will happen, especially when it comes to Credit Suisse, especially in European markets. And so consolidating at an elevated level and above 950 into the Fed next week makes it likely that we'll see another leg higher with the next target up to 2000. And we should wait for this consolidation to happen, to have a little to risk against, and then taking it from there. So that's it from my end. I hope you enjoyed this event. Lots of information. I just hope you were able to follow me and my thoughts, my game plan. So that's how I view the current situation. And how I traded it. So right now I'm long gold. I'm long gold based on what I presented in the morning, with a sharp breakout here on the upside. Currently running my direction. I'm not too aggressive with my stop. I potentially plan to add more if we get to see this consolidation higher. And I'm aiming for higher highs. So really aiming for 2000 and probably even higher than that. And the current environment is really perfect. It's the perfect cocktail for that. If you have any questions, feel free to shoot them over. If you watch this now on YouTube, then you can Okay. Then you can leave your comments in the comment section below. Also, send an email to admirals that will forward it to me, and I will do my best to answer them, so that you can profit from it. And that's it from my end. So all the best. Happy trading. Have a nice weekend. Enjoy yourself. And